Hello, welcome back to the continuing lecture in investments. Now, so in our last video, we started discussing the active bond portfolio management strategies. We basically, covered, we basically talked about, two sources of potential profit, and, which is, mispricing. One is mispricing, and the other one is interest rate forecasting. Actually, interest rate forecasting for the short term, like less than 1 year, is relatively not that difficult, or relatively more accurate. I would say, because it is short term, and there's always a guidance from the Federal Reserve. But long term, longer than 1 year, long term interest forecast is is rather an art than science. I mean, what I'm saying is that inaccurate and difficult, right? And when I say short-term interest forecast is, easier, that means relatively, relative to the long-term interest forecast, right? Even the short-term interest forecast is, most of the times, there's pretty much, a good margin of error. But still, we can rely a lot on the Federal Reserve's, guidance. And the interest rate movement is at best, within, like 0.25 percentage point. And at best, that's the movement within a year. I mean, sometimes, back in 2008, it moved like, like almost, 4 or 5% a year. But, in general, at best, even in a fast period of fast interest rate movements, it won't be more than 1%, because, the increase or decrease would be, gradual by like quarter percentage point, right, every quarter. But anyway, Homer and Lebowitz, remember these guys, non-Malkiel theorem, right? And they suggested some strategies, active bond portfolio strategies. And according to them, there are two types of, swaps. We also talked about this, in the last class: substitution and intermarket swap. And if we go into a further detail of actual, strategies, right? The first one is rate anticipation swap, which is, an action taken in response to anticipated change in expected interest rate. So generally, if expected interest rate is to go down, if, maybe I should put, right? So interest rate is expected to go down in the future, right? What do you need to do? Well, what you do is you sell short-term bonds, right? Your short-term bond holdings, right? Currently, your short-term bond holdings, you sell Um, and with the procedure, buy long-term bonds to lock into currently higher return. So this strategy is, quite, something quite. It makes sense, and is something that we have seen in, in times of, inverse yield curve, right? Why? What does that mean? Well, think about it. Why do you see inverse yield curve? This is, Finance 100 uh, topic, right? You see an inverse uh, yield curve when there is an anticipated um, when recession is anticipated very soon, right? Uh, in the short run, right? Which means in 6 months or the market is in consensus that the economy will go into recession. Now, what do? Uh, you generally sell your short-term bond holdings and uh, move the money into the long-term bonds. And why? Because currently, um, I, I mean, the purpose is different, but uh, the motivation is different, but actually they end up in the same result. Why? You want, your your concern is that uh, the short-term bonds will mature within, like within 1 year. It could be 6 months later or 3 months later. But if it matures when the recession hits, right? What are the chances of getting your money back? The chances of getting your money back goes down. Probability goes down. Of course. Why? Because it's recession. The companies would have hard time raising capital to pay you back. Okay, paying back what? It's the par value of the bond. So if the company has sold, $100 million worth of bonds, right, and they mature in 6 months, and you're going to receive, out of those $100 million, at least 1 million is yours. And what are the chances of getting your money back when the recession hits? When recession hits, it's clear that it's difficult to raise uh, capital, $100 million, uh, to pay back. So the default risk goes up. And as an investor, you want to avoid that. So what do? You take your money out of the short-term bonds. In other words, that means sell and then move the money into the long-term bonds. And why long-term bonds? Now, long-term bonds don't mature in 6 months or within 1 year. They are long-term. That means and so if you move your money into the long-term 10-year, the bond that still has 10 years left maturity, what is what does this long-term bond do? Do they pay out principal? I mean, do they pay out the par value in 1 year? No, they are long-term bonds. They have 10 years left, right? They don't need to. They don't need to dip into their pocket uh, to cough up, $100 million. Make sense? Until maturity, they only need to pay interest, coupon interest, right? So obviously the financial distress is much lower. In other words, default risk is much lower for the long-term bonds. And since they only need to pay out interest, coupon interest, they can weather the storm. They can weather the recession. Okay, you get that? So that's the reason. And of course, even when it's time to when it's maturity, even when they reach maturity and it's time to pay out uh, the money, right? They don't really cough up from their own coffer, right? They don't. cough up from their own pocket. They simply need to roll over, right? Now, during the good economy, right, it's easy to roll over your debt, right? Now, so that's why the yield curve is inverted. Uh, when recession is imminent. Okay, that makes sense. Why? Because as you sell the short-term bonds, what's going to happen to the return on the short-term bonds? Return on the short-term bond will go up, and as you buy long-term bonds, what's going to happen to the return on the long-term bonds? It's going to go down. That's why the yield curve is inverted. But look, it's the same mechanism, but in this case, a little different motivation. Motivation is interest rate is going to go down. Okay, in the future, let's say 1 year later. So then, short-term bonds, your short-term bonds will mature, let's say, in 1 year. Then you're going to move that money into, you're going to roll over that money, right? You will get your principal back, right? Par value back. But at that point, wherever, what do you put your money? Where do you want to put your money into? Where would you put your money in? You will still need to put the money in the bonds, but then overall interest rate has gone down in the market, so you don't, there isn't any more, high yield, bonds anymore. So before that happens, you move your money out of the short-term bonds and put it into long-term bonds currently, because now coupon rate is, you lock into the currently high coupon rate. Makes sense? You currently, lock into currently a high coupon rate. So for the next 25 years, you will be, locking into. So that is, rate anticipation swap, right? Now, swapping, short-term bonds with long. And then pure yield pickup swap. Pure yield pickup swap is, basically exchange of a short duration bond for a long duration bond for higher yield. Okay. Now, although everyone would want, everyone would like to, shorter duration, right? Because you're getting your, payback sooner, right? But why would you swap it with long duration bond? It's the same reason for that, um, uh, maturity risk. In other words, the longer the maturity, right? The longer the maturity, and of course, the longer maturity bonds have also longer duration. The longer the maturity, the higher the coupon, the higher the return, the higher the coupon rate, and thus, higher yield. So you want to, if you want to continue to receive higher yield, it's not the duration that matters. I mean, uh, I mean, suppose there's a bond that pays 20% interest for 30 years. I will be happy to put my money in, park my money there for the next 30 years. Every year, is 20%, right? So that's the pure yield pickup swap, right? And tax swap, it's swapping two similar bonds to receive tax benefit. So swap one bond into another one with lower price, and lower price means the price is lower, the capital loss will be greater. And why would you want greater capital loss? Because you want to claim tax break. You want to uh, it's capital loss. You want to write off taxes, right? You want to write off taxes. So those are the you know types of swaps, right? And they would, they are basically like substitution swap, right? All of these are substitution swaps, right? Substitution, they are substituting. Now, generally, in this is like interest rate forecasting, right? When example of interest rate forecasting. Um, uh, Usually, we use horizon analysis, and we discussed horizon analysis, previously, basically, and if you can forecast interest rate, and as I said, long-term forecast is, relatively, not easy, and accuracy is, relatively poor. But if you can accurately forecast long-term, then you would use, horizon analysis to maximize your, uh, holding period return, right? Uh, Now, we're going to look into an example of that, quickly. But here's this is a example from textbook. They actually uh, I just kind of summed it up. Fixed income strategy example actually used by Sanford, Bernstein, and company, right? Which is a Wall Street fixed asset um, uh, management firm, and um, and it explains basically what they use. They hardly they generally don't want to play with interest rate forecasting, but they uh, generally match the duration of the bond broad market bond index, right? And then also use Homer and Leibowitz substitution swaps and intermarket spread swaps generally. Okay. Now, so please read that. And here's the example of an horizon analysis. So a bond with 20 years to maturity and coupon rate of 10% paid annually currently sells at yield to maturity of 9%. From this, we can already tell, oh, this is going to be a premium bond, right? Of course, because coupon rate is better than uh, the market rate, average, yield, right? So hard to write. Okay, so but investor with 2-year horizon calculates total return on over the coming 2 years, right? Return on investment. This is actually, I don't know why it is, it's poorly written, because I may have, I would say, rate of return, or ROI, rate of return, or ROI. Yeah. It's got 20 years to maturity, but your horizon is only 2 years. That means you hold it for 2 years, and you're going to sell it in 2 years, right? In 2 years, right? Um, t- Time to maturity, time left to maturity will be 18 years, and bonds will sell at yield to maturity of 8%. So 2 years later, the rate will go down. And again, if rate will go down, what can you now coupon is 10% and yield to maturity is 9, it's already premium, right? But yield is going to go down much lower. What can you expect now? Of course, there will be your capital gains, right? This will serious capital gains, right? You can tell already. Coupons can be reinvested now. Coupons can be reinvested in short-term securities over the coming 2 years at 7%. Okay, all you need to do is then, currently current price, of course, plugging it into a using annuity. They don't. They just without showing you the full math, but you can do this. I mean, this is not annuity factor of 9% in 20 years. I mean, if you use a Excel or Excel's built-in function or financial calculator, and these days, you got pretty good, a free app you can download. I want to show you my, but this this is not something on a computer screen, so it's hard to. But you can use a free, financial calculator app, and you can easily, calculate the current price, a bond price, right? I'll call this B0, right? And this would be B2 because it's going to be 2 years later, right? And of course, right? And it comes to it's premium bond still 1,091.29. Now 2 years later, it's going to be annuity factor will be 8% discount rate and 18 years to maturity, right? And then again, using that factor, we get 1,187.44. I can, and then so basically, and then what about the coupons? Coupons can earn 7%, right? So for coupon, the first year's coupon will earn interest 7%, but second year coupon won't earn any interest, right? Because it will be paid at the end of the second year. So basically, coupons will be future value of coupons in year 2, right? Will be 207. So your total proceeds will be 207 plus capital gains. This is cash flow, and this is capital gains, right? I better not write there, I guess. Capital gains. So the holding period return will be 27.8%. Okay. Of course, you can annualize it by what? Taking the square root of taking like because it's 2 years, right? Raise it to 1 plus right? 1 plus 27.8%, so 1.278 raised to 1 over n, and n will be 2 in this case, minus 1, and then you will have annualized return, right? So that pretty much, explains everything about the active bond management strategy. And I just wanted to show you, let me, okay, I wonder if I can share this. So the financial calculator. So, all right, so let's see. Let's see. From my phone, I just captured the screen, and then let me share this. It takes so much time. This will be interesting. But I'm sure you're finance majors and you should know this. It's not coming up. What's going on? Okay, so let me download. Yeah. Why is it not showing? I just wanted to. It's going to be there. Just bear with me. I'm just downloading this image. Trying to download this. Oh, it hasn't been posted. Okay, so it's got to be there now. All right, so let me, or I can't even, okay, let me share this image. No. Okay, I'm gonna share, wonder if you can see the same thing. Here you go. I'll first have to stop this and stop sharing this and application with. Alrighty, it's gotta be there just about. Why isn't it showing it? Yeah, just about now. You see this? So this is the financial calculator app that I have on my phone, on my mobile phone. So you may download this too. It's it's not It's got some limitations. I mean, compared to Excel, using Excel is the best. But for a quick, time value of money calculations, I shouldn't recommend this. But for a quick, time value of money calculations, or like loan, internal rate of return and NPV, bond. I don't, trust that much, because, without beta, maybe, So you may, I recommend, if you ever want a financial calculator uh, app on your phone, I recommend this one. Okay. Or I don't know if you can. Yeah. All right. So that's it for today. And I will see you guys. That wraps up everything about bond portfolio management. And we will start on a new topic, risk and return, um, in the next lecture. All right. Thank you for watching. I'll see you guys in the next video. Stop recording.